editor of the Rural Investment newsletter. John's kindly invited me to sort of moderate and host a couple of panels today, so you'll be seeing a little bit of me. We're going to be sort of talking right now about gold, and I've a great pleasure to be joined from my right, far right, Mike Davies, CFO of Denarius Metals, Rob Eckford, CEO of Rua Gold, and Shaun Heinrichs, CEO of 1911 Gold. Let's start with the easy question. Who are you? Why are you here? Let's start with Mike.
Good morning.
That's not just me.
Are we on? Well, thank you, Paul, and good morning. Thanks for being here on a Friday morning. We're with Denarius Metals. We're a producer of gold in Colombia. We're Colombia's newest gold mine, ramping production up this year. And in the meanwhile, we're also now building scale for eventual critical minerals production in Spain. Our first mine expected to come into operation in the first half of next year.
Yeah, thanks again, Paul, for having us. I'm Robert Eckford, CEO of Rua Gold. We're a New Zealand-focused gold explorer that's quickly moving into developer with a very permissive regime that they've got in New Zealand right now. So in these current gold environments, it's amazing when you can get into cash flowing as soon as possible, and that's what we're looking to do in New Zealand.
Thanks, Paul, again. It's a pleasure to watch you up in DC, so happy to be on this side of the panel participating in this. I'm Shaun Heinrichs, as you introduced me, CEO of 1911 Gold. 1911 Gold owns the Rice Lake assets just in south central Manitoba. It's a fully permitted operation. We're currently in the process of advancing in the underground mines, getting it ready for production in 2027. We have some big plans to have some test mining in 2026 as well, and of course we're also advancing in the drill plan, drilling on those first few years of production and expanding a couple of new discoveries around the mine.
Thank you. As you can see, we've got quite a range of experience. We've certainly got a great diversity of geographies, emerging market. In gold, I'd say New Zealand's an emerging market, even though it's perhaps considered a first world country, and obviously Manitoba, I don't know, would that be an emerging market as well? Canada's obviously first world, but Manitoba is perhaps better known for base metals rather than gold. So we've got a diverse range of viewpoints. I'm not planning on touching on the sort of macro environment for gold because there's a lot of information out there about that, and some other people do that much better than I. We're going to be talking with John Fennick. I'll be talking with John Fennick a bit later on, and imagine that some of the macro environment will come up there. So we're going to perhaps focus more on specific things affecting gold companies, gold developers. And I want to start with the following. The gold price has obviously had a big run up. The first quarter results, we saw the gold producers producing record profits, record free cash flow. All-in sustaining cost margins of the better companies were bigger than the gold price was a year ago. And we're starting to see that reflected in their valuations. And I think it'd be fair to say a wider gap has opened up between the valuations of the producers and the developers and explorers. So let's take that as the next talk, the first talking point. Mike, why do you think that gap has opened up? Is it continuing to widen, or do you see signs of that? Or what will it take for that to close again?
Yeah, I think it's definitely widened with the margins that people are making, because as you said, margins right now are more than the gold price was a year ago. We saw that in our own production in the first quarter this year. We had a margin of about $2,300 an ounce on our production. We're still ramping up an early production, but what I think is causing that gap right now, I think it really is depending on how long it's going to take people to get up the development curve into production. Those that are near-term production will probably see better valuation. Shareholders are going to see cash flow coming, and cash flow is very important to shareholders. So I think the closer you are to production, you'll benefit from the re-rating. The longer term out, obviously, people have to wait longer. And what we hear from a lot of investors is, how soon are you in production? How soon is the ramp up going to take place? and how certain are you that you're going to be able to control your cost and generate those margins that everybody's seeing. So we're in good shape as we're starting to ramp up this year. We're looking forward to 2027, our first full year of selling concentrate. We'll be making about 30 million US of cash flow, and that's what our investors are sort of tracking towards to give us what we think is going to be the re-rating that comes along with that.
Thank you. Let's continue with Rob. The same question, maybe give it a twist more specific to an explorer. Does this sort of valuation disconnect, if you like, is that how you view it? How, as a CEO, can you try and close that valuation gap?
Yeah, I think I'm a bit of a mining macro nerd anyway, so I love looking at these sort of things. What I find when I analyze the market from this point of view is that for the first time in multiple years, gold investing is actually seeing inflows. And so if you think of new people coming to the gold market, the most comfortable space for them to start at is in a cash flow mine. They can put a value on it, they can assign some sort of tangible, this is the cash flow, this is what I can value it at, I'll start by buying these stocks. So I think naturally, if you're getting fresh buyers into the market, which is amazing, we haven't seen that for a long time, they'll start with the cash flowing companies. The disconnect to the explorers, I totally agree with Mike, and hence why we really are focused in New Zealand on this 6-month permitting they have, the value that investors see for Rua Gold, and why we maybe get a better valuation than some other explorers in more difficult jurisdictions, is the fact that there is that legislated path to cash flow in a safe jurisdiction. And so we get a bit more credit than just being your average explorer, I'd say, and it's a nice position to be in, that Rua has a fairly good supportive shareholder base because it shows that path to cash flow, even though we're in an explorer phase today.
Okay. Same question for Shaun, obviously with a Canadian Manitoba twist. Given that Manitoba, as I said, is better known for base metals production, the gold story is more a relatively newer story. Do you see that reflected in sort of valuation metrics, or do you benefit from the overall Canada's a tier 1 safe jurisdiction that supports your valuation?
Well, I appreciate you helping me out there, Paul, because I was listening to two great answers and wondering what possibly intelligent response I could give at this point. To add to that, I think you did hit something there. Obviously, jurisdiction is critical when people are looking at investing. Just to support Mike's comment in particular, we get obviously a lot of questions around time to cash flow for the company, and being so close for 1911, similar to the others. Does set us apart. I think when people think about gold prices, they know where it is right now, but there's still a long-term projection that a lot of people deal with. And if you're 3 to 4 years out, obviously that impacts their view on the potential long-term profitability. People kind of say, oh, well, gold's going to go back down to 3,000. So companies that are in a position to capitalize on this kind of $4,000 to $5,000 potential gold price in the near term are a little bit more attractive. Those that are in jurisdictions that are known for allowing projects to go forward, get permitted, like in Canada. Canada's also known for being, excessively long in the permitting process, and is clearly trying to get past that and find avenues to permit things faster. I'd say in our particular case, to just promote 1911, of course, but Manitoba's very keen to see these projects go forward. Alamos got their permits for Lynn Lake. It's a massive project. 1911 has had significant support as well, so that's a sign that things are turning the corner, and that helps to convey that we're in a strong position to capitalize on these gold prices. And again, the near-term focus of a lot of investors is what sets the producers and near-term producers apart from the advanced explorers. And of course, to Rob's and those points, like those that look like they're in a good position to advance their project and be able to take advantage of it, even in the next 3 years, stand apart from those that are kind of 5 to 10 years out and have a much better opportunity to finance and capitalize their projects.
Okay, thank you. Now, a key element in a valuation is the gold price, the reference gold price you use to calculate whatever it is you're calculating. The majors are starting to increase the prices they use for their resources and reserve calculations. I think reserves are now, let's say, $2,000 per ounce, reserves $2,200, $2,300. When companies do PEAs or economic studies, they're typically using a base case scenario of $3,500 US dollars per ounce, and more of a spot option of, let's say, 4,500 or even higher. Companies have to, particularly in the economic studies, typically use a 3-year rolling average or equivalent thereof. As developers, is that frustrating that there's such a delta between the base price you're effectively forced to use by the industry and the price we're actually seeing? Does it make it difficult to sort of daylight the value in your projects? And let's go the other way. Let's start with you, Shaun.
Did it die? There we go. Thanks, Paul. Look, for us, using the lower price obviously is not a huge issue. I think it creates a sense of discipline around how you manage your asset. Obviously, we want to have it creep up as kind of 2,500 starts to seem a little bit unreasonable. You want to push it up a little closer to 3. Nobody wants to be doing their models at 4. So I think, sticking to a lower price in the near term, and everybody usually does that modeling in the background at those higher prices internally anyways, and you can use that to kind of say, look, what's the upside here? What's the upside in terms of with that higher gold price, what comes into the plan, what changes, what kind of production numbers are you looking at? You have those numbers internally, and you can work with those. So I think for us, it's not a major concern, and we think that it shows that there's a resilience at lower prices, and that should be attractive as well. So we're happy to work with that method.
Okay, thank you. And Rob?
Yeah, I think it really, you need to do it. I think we're all sitting here as CEOs and executives of gold companies. So we obviously believe in gold. We think it's got a long way to go and it's got a good trajectory. But we also can't ignore the fact that in 2014 it went from 1,900 to 1,000. And so we know this is a cyclical business. We know that it goes up and down. And so if you're not pressure testing your base case, and who knows, we could see $3,000 gold. There's crazier things that have happened in the world. But yeah, if you're not pressure testing your base case enough, then I'd say it's fiscally irresponsible.
Okay, thank you. Mike?
Great, thanks, Paul. Yeah, this has been a very important topic for us of late. This Zancudo project in Colombia for us just went through a resource update back in October, and the debate that the technical team and I had was, what price are we using for the resource study? Obviously, as you mentioned, the industry still looks at sort of trailing 3-year, average, and so we use that for our study. Then we used we lowered the cutoff grade to 3.5 grams from 4 that we'd used back in the 2023 study. But then when we fast forward to March and we're publishing our updated PEA, in 2023 we used $1,800 gold at a time when gold was around 2,000. Now we're sitting there looking at prices where they are and gold being up over 4,500. It's kind of hard to think about giving investors a scenario at 3,500. So we took maybe a bit of a bold step and chose $4,000 as our long-term gold price. And that got us $450 million of all-in sustaining cash flow after tax, which is a great result for us. That's up about $200 million from where we were in 2023. But important, I think, is also to give investors the ability to see the variation in your results, sort of plus or minus 25%. So we've given them a table that shows everything from a $3,000 gold, step-by-step $100 an ounce, all the way up to $5,000. Let them pick their particular position on where they want to be and be able to look at the revenue, the cash flow, the margins, the IRRs, et cetera, all the way up the scale, and not try to force them to pick a spot. Let them choose their own, depending on where they want to be.
Thank you. And I'll just conclude in this particular session. Pretty much every CEO you speak to claims they're undervalued, and it's not just a glib comment, because there are reasons behind that to a certain extent. As I say, the industry, to protect against downside, typically uses a 3-year trailing average of the gold price to be conservative, to show that a business is resilient at a lower gold price. So it's not just sour grapes there when companies claim they're undervalued. Valuation's also a very critical thing in mergers and acquisitions, and we've seen some big transactions lately, and the expectation is there's going to be more. Part of that is because the gold producers are depleting their resources. They have to replenish and replace them. They can do that to a certain extent with exploration, and the best majors literally just manage to replenish what they're mining. So there's not a lot of resource growth out there. When you look at the numbers, the aggregate gold production, if anything, is flatlining or trailing down. So there is a real need for the producers to replenish and replace their ounces. They're only able to do that to a certain extent or limited extent through their internal exploration. So of course that means they need to break out their checkbooks and buy other companies. They're getting into a very good position now with very, very vibrant balance sheets. They're very well cashed up. And so the anticipation in the sector, from my point of view, is that there will be more M&A. And I want to push this point to the panelists now. M&A, where are we? Where do you think, what kind of assets are going to be in demand? And again, let's start with Mike and come back towards me.
Yeah, great, thanks. No, I do think that we're in a period where M&A is going to be picking up a little bit more steam as we go ahead. Consolidation is the way to get scale. We certainly, are on an ongoing basis keeping our eye and getting things introduced to us in the jurisdictions that we're in, particularly looking at how we can create scale, create longevity, and bring assets in. In Colombia in particular, it's a jurisdiction that still has a lot of open area for expansion. There's some new junior companies in the space that I think are also desiring, eventually an opportunity to be taken out by somebody. But letting somebody else do some of the work and put their risk capital at it is a good way to de-risk your own exploration program. At Denarius, I think, we've got some great assets. We're not ready to throw our hat in and be taken over, but I think what we're looking for is more opportunities to grow through M&A, is if the opportunity puts us with something that's going to fit the profile what we want going forward.
Thank you. And just as a coda to that, Mike, in his previous companies, he's been involved in a lot of buying of assets and companies, selling assets, consolidating, spinning out. You've pretty much been around the, Rob.
Yeah, I mean, I in my last role, I actually bought 2 of Mike's companies. So we had a long history of M&A. I mean, with my current Rua Gold hat on, I mean, maybe before even talking Rua Gold, I think the M&A space is an interesting time right now. I think the last sort of 18 months as gold has gone from 2,000 to 5,000 and has settled again, I think it's hard for majors to sort of plug a $4,000 long-term gold price into the model. There was a lot of volatility in an upward trajectory, which is great. I think now we're in a bit more of a stable gold price and people are getting a bit more comfortable that maybe 4 is the long-term base case or something like that, and you can plug that into a model, you can get a bit more comfortable with valuations, which enables M&A essentially. So I think as we're seeing a rise in the gold price, I think you're going to get more M&A naturally because companies are sitting on cash. There's only so many share buybacks and dividends you can pay. You need to replace reserves. And so I think as they're getting more comfortable with these longer term gold prices, I think we'll start seeing more execution. For Rua Gold specifically, I mean, we're definitely, we don't have a for sale sign on right now. We've spent the last 6 years, part private, part public, putting this whole thing together. And we've got to demonstrate to both the market, our shareholders, our long-term shareholders, that we meet some of our milestones that we promised. But I do think there's a future where we will be an attractive asset because tier 1 jurisdiction, people like safe ounces, and New Zealand will fit that bucket.
Thank you. And Shaun?
Yeah. Thanks, Paul. Look, just to, I guess, add to what the rest of the panel was saying, there's multiple reasons for companies to do M&A, and they vary depending on the size of the company. So you specifically noted the seniors, and obviously they're looking for replenishment. They typically look for size. So when you're looking at potential targets for seniors, you want to focus on those that have scale, clear scale. They're looking at projects that can produce well in excess of 100,000 ounces, at least have a visibility into that. So anything kind of smaller tends to be off their radar, not because there's anything wrong with the asset, it's because for them, and with anything in life, you do the same amount of work regardless of the size. So they want to focus on things that will have a meaningful effect. So we will see more, obviously we'll continue to see more acquisitions given the amount of cash sitting on the balance sheet of those companies. What I think is interesting is more the separation between companies more at our size, and I don't have everybody's market cap memorized here, but looking at more opportunities, synergistic opportunities, and there you get into M&A deals that happen because there's proximity, ability to combine two assets that are close together, centralize a mill, centralize some logistics. Those happen a lot. We've seen some quite recently with more mid-sized type companies coming together. And then on the smaller side, you see some mergers of equals, typically where there's a mix and match of management team where there's some strengths and weaknesses in each, and they can be combined to be a much more effective management team. What you don't usually see is two developers coming together, because that's two headaches now slammed together. Unless one's a little bit further along than the other one, and there's a potential for cash flow from the original asset to be able to fund a lot of the development related to the second asset if it's a year or two behind in the process. Where I also see M&A potentially happening is there's, in this industry as in others, there are management teams which are either technically a bit stronger just because nothing fundamentally wrong with the other one, just to have the advantage in that regard, or they have better access to capital and are able to raise cash at a lower cost of capital. And that could be because the project they're involved in is better, which is allowing them to tap into markets. And then using their technical team, they're able to identify opportunities, not necessarily massive opportunities, but opportunities that are suffering for a lack of capital, and they can step in and assist on that front. So I think in this market, we'll continue to see that activity. We might see it pick up given the gold price and people looking for cash flow. I mean, even a 30,000 ounce producer is quite attractive at these prices, and a 30,000 ounce producer plus a 70 or 80,000 ounce producer gets you to 110, and that gives you scale to buy something that might be a 120,000 ounce producer somewhere else. So those types of opportunities will continue and especially accelerate once gold price starts to recover and move back up and show clear evidence of the long-term bull cycle we're in. So that's.
Thank you, Shaun. I want to sort of continue with this theme, but perhaps look at some of the other drivers. We talked about one of the key drivers is the major companies need to replace and replenish their reserves and resources. And they're sitting pretty in a very pretty spot right now, because as we talked about during the first theme, their valuation, there's a valuation gap between the producers and the developers and the smaller companies. In roundabout terms, that means an ounce on a major's balance sheet is probably worth, what, $500 or $600 per ounce. On a developer's, it's what, $100, maybe even $200 per ounce. So just buying something, they get an immediate lift there, which enables them to pay out pretty significant premiums, and they're still well in the money. But what are some of the other drivers that you think could drive M&A? A lot of juniors and developers, they've been able to raise money, so their situation's completely turned around. They don't necessarily need a deal right now. They don't have that urgency to make a deal to survive because they're cashed up. Are management still entrenched, or given their shares are now worth a lot more, are they looking for exits? What do you think will be some of the drivers? Shaun, let's start with you.
Sure. So I touched on a few of these. I think it's a good time to actually highlight the barriers to M&A, because you kind of mentioned it. Management's usually the barrier, because often management team can be quite entrenched and reluctant to give control of an asset that they've been involved in for a long time over to another company, even when it's in the best interest of shareholders. So as an investor, that's just something to be aware of. Most investors that you meet at these conferences always ask you, what's your goal, and they can kind of feel out whether or not you're overly protective of your asset or whether or not you're open to opportunities. So it's just a good way to kind of vet. You don't want a management team that's going to be a barrier to a potentially significantly accretive acquisition. Most investors do like to see the company take it as far as possible without blowing up the capital structure. But to your question, I guess the reasons for M&A are that outside of the usual strategic part of adding two assets together that are close by, you look at things like strength of the management team, the technical strength of the management team, the ability to raise capital, which I mentioned, whether or not that's stronger with the second management team. If they're able to capitalize a project at a much lower cost of capital than the other one, then that would make a lot of sense. And then also diversification of production. So for a company like 1911, it's close to production. It makes sense to kind of look around and see if there's other sources of production out there that could be added. You're not going to find something really close to our project, unfortunately, that you can truck there. You're just going to be expanding our current project size and looking for more mines on our, on our land position. But you can look for bolt-on operations that are cash flow positive, even if they're smaller. That would make sense. And we have the management team, obviously. That would be something that we would entertain and we would look at. So it's specific to us, but that's another way to think about it.
For you specifically, Shaun, what sort of time horizon does that potentially materialize?
Look, we're always looking at this point. I think we've talked about market cap. Market cap's a big factor. When you're a 50, 60 million market cap company, it's tough. You can do a merger of equals. Again, going back to that management team strength and combination of the two. But when you're a bit larger, 200-300 million market cap, then you can be a little bit more ambitious in looking for projects. So our time frames, we're not looking at anything like specifically right now, but we're certainly evaluating opportunities out there right now and seeing if there's anything that makes sense for us. People will say, well, you should wait till you're into production, but obviously you don't want to let opportunities pass you by either. And if your balance sheet's strong and your management team's strong technically and you can take it on, then I think it's always worth looking, as long as you're not getting distracted.
Thank you. Same question for Rob, but I want to put the twist on it about Rua. Given that you're in New Zealand, New Zealand's perhaps not the first, second or third jurisdiction people think about when they think, well, let's look for a new property. So does that mean that you would have to be sort of more proactive going outbound to look for potential things that might work and make the proposition to others to say, hey, let's do something?
Yeah, I mean, one of the most common questions I get from investors when I talk to them are, why the hell are you listed up in North America? Why aren't you on the ASX? You're down in New Zealand. And I mean, the background for us is our cost of capital, our network of investors is very much North American focused. We've had a lot of success through the last 3 or 4 companies we've built, and our network of financiers is North American. And so that's how we've started Rua Gold, and that's why we're North American focused. But if I look at where I think personally our likely takeout will be, I think it'll be from an ASX company. ASX gold producers right now are making so much cash. The Australian gold price is like $7,500 an ounce in Aussie dollars. And so you're getting these huge margins down there. They're sitting on walls of cash. And their investors don't have the appetite for spicy jurisdictions like Southeast Asia or Africa. And so the most obvious expansion for an Aussie company, where Australia is quite picked over now, is going to be into New Zealand. I think New Zealand needs to remain a pro-mining government and remain a pro-mining jurisdiction for another couple of years to really prove to the Aussies that something's not going to change there. But if I'm using my crystal ball, I'd say we're more of a target for an ASX company, which is important as well, because if you're thinking about your North American shareholders, we don't want to suddenly just go along to the first ASX company that comes in and offers us a bunch of script. A lot of our North American shareholders aren't going to want to hold an ASX company's shares. So we need to be very cognizant of what a takeout target looks like, and it will need to be more cash-based, or it will need to involve a dual listing like some of them in the past have. Westgold and is now dual listed because of their North American acquisition. So yeah, I don't have a crystal ball. I mean, the only thing I'll add is that it's about cost of capital. In all my M&A experience, and I worked with Neil Woodger. We call him Neil the Deal because he just does non-stop M&A to build companies. And you've talked to him non-stop. We've bought 2 companies from Mike, and generally it was because our cost of capital was cheaper. And so it made sense for us. We could raise the money, even in a difficult market in the last 10 years, we've been able to raise money. So the biggest growth story in the gold mining space is Zijin Mining. They have the cheapest cost of capital in the whole industry. So if you can improve your cost of capital versus your peers, you then naturally have that accretive advantage. And we've done it with Rua. We took out our neighbors and we had a better cost of capital than them. We've done it with Aris and worked with Mike a lot. So I think that's the key part that investors need to look for as well.
Without being too cute, how would the Kiwis feel about being taken over by a bunch of Aussies?
I mean, I think it's the same relationship as the Canadian-US. You know, it's friendly, but it's competitive. Yeah, exactly. US is Canadians' little brother.
And how do the Canadians feel about that? Well, let's not go there. Mike, let's quickly move on.
Sorry, yeah, I think, obviously I think in times what we've seen is M&A happening as a result of just even companies getting together to promote, you know, how do they exploit a district play. But I'm going to take a little different direction when I think of what we're doing in Spain. And M&A now being an extension of our opportunity to tackle what we're trying to do in the production and supply chain. It's about taking a company and saying, I got a great project and I can mine it, but now I need to solve for the processing side. That led to us doing some M&A to go and find a company in Spain that actually had a processing plant and buying into the plant that's already built, that's already permitted, and accelerating our timeline to get into production, because now I don't need to go get the permits that Robert and the others have talked about. I've got a plant that's there and ready to go. But then as we look at processing and getting the maximum amount of material out of the ore, recognizing that we need something else in our supply chain, and in our case we need a roaster so we can get the gold out of the pyrite. And as we start looking for that opportunity, it leads us to further M&A, which is taking shape in terms of a strategic alliance with a very well-connected group in Saudi Arabia that is putting together roasters and other facilities and looking for feed from mines outside Saudi Arabia to fill this industry. So it's an opportunity for us through this M&A profile to be able to continue to get the most for our shareholders without having to continue to do dilutive financings or heavy debt financings to build these facilities. We can actually take advantage of existing facilities being built by others and working them into our structure. So I think M&A is also about strategic alliances at times to get there faster and get over some of the hurdles that companies of the junior size have to face, because we don't all have the balance sheet or the capital structure that can sometimes build these kinds of facilities, but they are out there. For instance, our Toral project in the north of Spain, we're doing the same thing. We're starting to look around at plants in the north that have capacity that I can, again, fast track. I can build the mine, but leverage somebody else's processing plant to get there. So I think this is another shape that juniors getting creative about how they get to production quickly will start taking a look at down the road.
Thank you, Mike. I'd like to move on to talking about financing. With high metals prices, copper, gold, silver, the financing window I'd say has been open for quite a while now. Some companies have been able to raise extraordinary amounts of capital. Equity is not the only capital available. Debt is pretty much fully available now. And there's also some weird and wonderful things: gold-linked notes, silver-linked notes, converts, royalties, streams, etc., etc. So we're going to focus a bit on financing, and I'm glad we're going to start with Mike, because Mike has been, in the past, particularly with Gran Colombia Gold, very creative in generating financial solutions that were effective and enabled, in this instance, Gran Colombia Gold to survive the market downturn. But not all financings are created equal. And it's not just about the cost of capital. There's often a lot of strings attached which can tie a company's hands, whether that's covenants on debt or other things. Streams and royalties never disappear from your balance sheet. So although companies may say they're non-dilutive financings, they are, just not in necessarily the most obvious way. So Mike, let's start with you. What are some of the things that people should look out for investors should look out for when a company announces a non-traditional financing package?
Yeah, thanks. And Paul's correct. Over the last 12 years, we've done a lot of different kinds of financings, and the market often drives what you're trying to do and what you come up with and what's the flavor of this year, what's the flavor of the market. We've definitely done a lot of equity offerings, but we've looked at streams, we've looked at royalties. Robert inherited 2 streams that we put together. I'm not a fan of streams. I don't like them for the basic reason that they can be complex to put into place, especially from a tax perspective, but more importantly, they live forever. And so it's really hard to go to your shareholder base and tell them that you've done a financing, but somebody's going to have a call on your gold for a long period of time with some, different economics, and they want the upside on that. Royalties, I think, can have a place, but I'm still not as much a fan of them. But we've, over the years, as Paul alluded to, we've done commodity-linked financings, which I always refer to as a franchise security that our chairman and some investment bankers created. The first one in 2011, it was a silver-linked note. We've had some gold-linked notes. Robert inherited one of them as well from us when they took over Grand Columbia. In fact, two of them. And I think they are an interesting opportunity to our chairman's, philosophy there was put a security back out into the market that as gold goes above a certain base price that you are comfortable, your operations are going to give the cash flows back to the company, you can share some of that upside in gold through a gold premium, for instance, that gets paid to holders. I think it's a terrific instrument. One of the things I like about it is they're short term. They have a finite life. So it is a way to attract public investment with a bit of an upside kicker in your return. The downside, I think, are two things. One, maybe being a little bit more like a CFO, is that they will create balance sheet volatility under current accounting rules, and you'll have mark-to-markets that'll go through your P&L and really distort your earnings, and it'll force you into adjusted earnings disclosures to try to normalize and show their true effect of your P&L. The other side is if you don't carefully design them, you can end up in a situation where the gold market rapidly changes, and suddenly those gold premiums are far more expensive than you ever intended. And looking backwards, we did that with a 2023 convert that in a $2,000 gold market made a lot of sense, and in the upside premiums were expected to be 30–40%. But in this market, the gold premiums are 100%, and we're now tackling how do we deal with that. We know we've got enough cash flow to cover it, but investors are still concerned when they see you paying out that much debt service. So I think with anything, you have to really carefully study the commodity-linked debt that you're going to get into, whether it's royalties, streams, or otherwise, and look at the long-term effect on your shareholders, decide if that's the path you want to go down.
I think one thing to sort of highlight there, on a gold-linked or a silver-linked note, there's a specific amount of gold, and obviously as the price changes, the actual value of that changes, but the amount of the metal doesn't change. So at $4,500 gold, it looks exorbitant, but it's still the same number of ounces. Rob?
Yeah, I mean, I'm a big fan.
Well, let me sort of interrupt you there. As Mike mentioned a couple of times, I'm sure he wants you to comment on this. You inherited a couple of notes from Mike. What was that like?
Yeah, I mean, I have a lot of respect for Mike because, as you said, easy. I wouldn't say easy, but much easier today to finance a mine build with debt and equity. Very simple. The market's open, the debt market's open. Mike lived through the downturn. He went from the 1900 gold down to 1200, 1100 gold, and equity markets tightened up, and you had to get creative. Fast forward, and eventually, when we bought his companies out, we inherited, as he said, the headache. And it is, you pay the accountants too much, you pay the lawyers too much, and putting that aside, your cost of capital changes drastically, and you take away some of that upside. But it's a necessary evil in a downward trend. So you can't fault him for it, but personally, in our experience, we try and keep it as simple as possible. We like the A-grade debt you can get is interest only for X number of years until you've reached payback, and then a bullet payment at the end, because then you can look at a refinancing opportunity once you're 5 years down the road, 6 years down the road. And so we've done that a lot with Orion in the past. It's expensive, and as people should know, the headline interest number isn't the cost of debt. There's warrants attached to it. There's a debt discount and a financing fee associated. So there's a lot of hidden costs, but actually operating it and operating the business under that simple structure, once you've gotten the upfront costs out the way, is much simpler to manage the business. So that's A grade. Maybe even an AA plus grade is what we'd like to see at Rua, and wouldn't promise anything to shareholders, but this world of critical minerals we live in now, also opens up a whole different avenue with governments looking to secure supply. And so we're definitely going to go down that path and see if we can find some strategic financing for the antimony on our property. And we definitely have interesting meetings with governments. But if companies can secure that, and we see Perpetua in the US, I think today announced $2.5 billion package from XIM, these sort of financing packages are the creme de la crop of the industry, and it's never been seen until today's market. So that's where the critical mineral spin is also an important one to consider.
Thank you, and I just want to sort of riff on that a little bit. One of the key things the US government has identified is that China's lower cost of capital is a key factor in why they've been able to take dominant positions in a lot of minerals. They also have a lot of minerals as well, which is more difficult to replicate, but the US has certainly singled out the fact that it can provide or advance at lower cost of capital to remove that or to level the playing field in their parlance there. Rob, before I go to Shaun, I want to sort of follow up on what your comments about debt. Why do companies, once they get into production, seek to almost immediately refinance their debt? What's the thinking there?
If you've done things right, if you've built it on budget, on time, and you're now cash flowing, your credit rating has significantly changed. And so you can go out and actually find a cheaper debt because you can actually demonstrate cash flow, and you've got much more availability. You don't have to go to the Orions of the world, which are predatory early debt lenders. You can go out to banks, and we see it recently with Orla. I think they secured notes at 4.125% or something ridiculous like that. So as you go from development into production, your credit rating improves and you can get cheaper debt.
And does that also enable you to get out of some of the covenants that tie you up?
Yeah, definitely the covenants, and sometimes even the hedging. I mean, some of the hedging and Macquarie's a big component of this. They love hedging gold prices when they're financing a gold project. In this market especially, it destroys a lot of upside, and so you see a lot of hedge books getting closed out early, and sometimes even financing an early closeout of the hedge book is a good strategic option. So yeah, the covenants and the restrictions on the business are very important as well.
Thank you. Let's move to Shaun, and I want to sort of reframe the question because as you've spoken about, you're sort of moving towards that sort of development stage. So in terms of financing, what are the kinds of things you're being offered? What are the kind of things you're thinking of? What's your ideal package?
Sure. Yeah, no, just want to first just back up and say, as Rob mentioned, we're in a bit of a different world for financing these projects at this point. Equity markets were pretty dry for a very long time with the same pool of investors making their investments. So not a lot of capital available, and then you're in a position where Mike is, where you're trying to advance something that you see of incredible value, so you're entering into more creative instruments. And so we're kind of past that. Companies have better options. It still tends to be an option though, and where I think as an investor, where you look, you've got to look at the type of company you're investing in and respect the type of capital that they need to raise. You're not going to have an exploration company taking on debt, and I'll talk about us in a second, but you know, they're not in a position because they don't have security, they don't have cash flow, and if somehow they do take on debt, that's probably a sell for me as an investor anyways. But what you want to hold them to is progress, clearly. So if an exploration company takes 10 million of equity financing, by the time they come back, they should have meaningful progress, have created significant value for that 10 million. They should return that 10 million into 50 million at least, if not a lot more in terms of value, because we all have pretty high return thresholds. So that's how I look at equity financing, particularly for smaller companies. Now, when you look at the more advanced, like most of us up here, and particularly 1911, and Mike, I think, but we have access to debt, because we have physical security at site with, a mill infrastructure on site, mines, significant resource. We have visibility on cash flow. So that opens up things. We're still at the stage where you were talking about, where we're focused more on kind of mezzanine type debt, which is a little bit more expensive with the exact same plan you just talked about, which is when you get closer to production, you take it out with something a lot less expensive, because you're in a position to do that where you've now realized and crystallized your plan and started to cash flow and show that your operational costs are close, if not right on target with where you want to be. Your capital costs are largely spent. Now you can kind of lower your overall cost of capital. A company like myself would still consider Other things like equity financing, particularly because our cost of capital on the equity side is significantly lower than what it was a year ago because of the value that we've generated, mostly because of the plan we've pursued and the results that we've had to date. And so we have a significant value accretion to us, which allows us to raise some equity. And why would I do that? Well, because it's more flexible, obviously. You need to also protect your shareholders. So, taking on a lot of debt as a company that's going into production is not a really great idea because, things are never going to go right when you're starting up. We've seen that with West Red Lake. Obviously, they're struggling a little bit with getting to where they need to be, and they've got debt they got to deal with, and so they've got to push hard. And I wouldn't want to do that to our company, but at the same time, you need to balance out your cost structure and make sure you minimize your dilution at the same time. So it's all about being a bit strategic in how you capitalize your project. Try to match the investments with the types of capital that you're spending. So if it's still exploration and resource growth, equity still makes sense. If you're talking about building structures that are potentially value generating, like adding onto the mill or something like that, then you focus more on debt because you're obviously doing that with the idea that you're going to be able to pay that debt back in a reasonable time frame. So.
Excellent. Thank you very much. We are out of time on this gold panel, so please join me in thanking Mike Davies, Rob Eckford, and Shaun Heinrichs.